Retained earnings are a fundamental part of a company's balance sheet. Let's break down what they are and why they matter to investors. Think of retained earnings as the profit a business holds onto, rather than paying it out to shareholders as dividends. This simple calculation shows exactly how much money a company has generated and kept over its entire lifetime. Companies use these funds to grow. Keeping cash inside the business allows for expansion without needing to borrow more money. It is a common mistake to think retained earnings are just a pile of cash in a bank account. They are an accounting metric. This chart shows a hypothetical company that decides to keep 70% of its profits for growth, while paying out 30% to owners. When you see a company with high retained earnings, it often signals they have a strategy for long-term internal expansion. Understanding retained earnings helps you see how a company manages its success. Thanks for watching, and remember to subscribe for more finance basics.